This episode is brought to you by Alpha Architect for Advisors. Whether you're an established firm or just starting out, you know the right systems can be the difference maker to achieving your growth goals. That's why Alpha Architect now offers a suite of turnkey model portfolios that can be customized to fit your practice. Built on Alpha Architect's decades of rigorous academic research, our model portfolios aim to systematize portfolio management so that you can spend less time tinkering with funds and more time finding your next great client. Systemize today to save time tomorrow. That's building with conviction. That's Alpha Architect for Advisors. To learn more about Alpha Architect's model portfolios and to schedule a consultation, visit advisors.alphaarchitect.com/models. That's advisors, ADVISORS.alphaarchitect.com/models. Alpha Architect for Advisors, built with conviction. Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at VALIDEA Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of VALIDEA Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of VALIDEA Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Bruce Lavine, CEO of NightShares, to discuss the night effect in the markets. This centers around the idea of investing in versus during the day in order to achieve better risk-adjusted returns. Bruce shares some of his research around the night effect, explains why the night effect exists, and how he and his team are harnessing this to the launch of a handful of new ETFs. This is another example of a small ETF issuer with a new and different investing strategy. As always, thank you for listening. Please enjoy this discussion with Bruce Lavine of NightShares. Hi, Bruce. Thank you for joining us today.
Hey, Justin, how are you?
We're going to spend most of the time talking about the strategy that you deploy at NightShares, and it's based on an anomaly that I didn't even really know existed in the markets. You think that you kind of understand most of the strategies that are out there. Of course, there's hundreds, if not thousands, maybe tens of thousands of different investment strategies. But I mean, what you're doing is, I think, very unique. It's something I've never heard of. And I think our audience is going to be interested in learning about this. So thanks for taking the time.
Absolutely. I hadn't heard about it either until a couple of years ago.
Well, and you have tons of experience in the ETF space. So in your career, you were at iShares, you were at Wisdom Tree for a number of years. And so I know from your purview, you've seen a lot of different investment strategies. So this is going to be, I think, fun to talk about. But where I wanted to start with you is at a higher level with the ETF landscape sort of in general. And I just wanted to hear sort of your thoughts on what you think the future of ETFs are. Obviously, they've become more popular. Investors are, adopting them more. I was looking, I think in 2022, there was a decline in the number of ETFs new issues that came out, but it was a slight decline. It wasn't anything crazy. There's still like 470 new ETFs that came out. So there's still more ETF launching, but just kind of to get your sense as to where you see the ETF space going, and also maybe comment on, we know that ETFs are largely dominated by like a few of the major players, but how you think small issuers, and you're one of them now, sort of fit into that.
Yeah. So, I mean, there continues to be this tremendous shift, towards ETFs by investors. And you've now seen the mutual fund industry probably 15 years too late, almost throwing in the towel and saying, I got to take my existing funds and convert them in some cases, or create, near clone versions of them in ETF form. So, that's going to continue. There's a lot of product out there, no doubt about that. And there's a lot of really interesting strategies out there. Like ours, but many others. You're seeing, things that can only have been done in hedge funds 10, 15 years ago are now being done in an ETF format. And so I expect that'll continue. I don't see any other structure, better suited than the ETF to continued innovation. Your question about the big guys, the little guys, I think there's a lot of innovation coming from the little guys. You see that continuously, and I don't see that changing. It's hard. It's hard as a little guy because you're trying to birth a new idea and a new concept against some bigger spenders. But, don't see there's any reason when there's a strong idea, you can't have success.
We had an ETF for about 5 years that we ran. We like to tell this story. We launched our ETF, which was a small cap value strategy, the same week that Kathy Wood launched ARK. And so, and we're more fundamental investors. So, we were like, oh yeah, our ETF's going to do so well. And who is this disruptive ETF over here? What type of strategy? And I mean, we kind of know what happened, although ARK's fallen off, but still, I mean, Kathy had a great, basically built a great firm over there. So what do you think in your experience? I mean, you've worked at large ETF issuers and you're now at a very small one. I mean, what are some of the key differences? Is it you have to wear 12 million different hats and you don't have a chief compliance officer? What would you say?
I think it's just, of course, all that, but it's also just evolution of the industry, against that, right? Which is, in my time at iShares in the early days, it was much more of a land grab, right? We knew the ETF pool was fantastic and we were just trying to put it in places where it didn't exist, right? So, we had the first of almost, other than the spider and the sector spiders and the QQQ, we had the first of almost every category. WisdomTree was, the first ETF provider that basically said, we're going to do something other than cap-weighted indexes. And so that was a different education process. I'd say now, there's a lot more product. There's like 15 sponsors for a lot of years. And now there's over 100. So I think it's the strength of the idea that is required today, to stand out. And that's why I felt good about launching NightShares. We thought it was a really strong idea and one that, had sort of the academic and quantitative underpinnings that the market would like, and just hadn't made it to the market yet. So, it's a different game than it used to be. There's more players, there's more gatekeepers on the distribution side, but at the end of the day, the customers, continue to embrace the structure, and that's the good news. So that the pie is growing.
So you mentioned the strong idea. Can you just explain sort of what led you, the story that led you to find this?
Yeah. So I was working with a sister company of ours, and they were running a hedge fund, and they were showing me some of the signals that they used in the hedge fund. And they had two that were the most prominent. And one is this thing we call the night effect. And they were showing me that most of the returns were coming at night over time with a lot less volatility. I couldn't quite believe the numbers. And I kept asking them to show me more data, more numbers, more timeframes, more segments of the market. And so we tested this on, large caps, small caps, US, non-US, individual stocks, concentrated sectors, and we still getting these very consistent and persistent results. So that got me extremely excited. And then I looked around and saw for about the last 20 years, there have been academic papers written on this topic. And the data on those goes back to the late 90s. And they are saying something's going on at night where there's excess returns. And, there's different explanations for it. But, so I got very excited and got some backers and formed this company. And we launched funds in June of last year.
If you looked at the total return, the total volatility of the S&P 500, how much of that is during the day and how much of that is at night?
Yeah. So over 20 years, ending at the end of 22, the S&P did about 9.5% annualized, and about 7.5% of that came at night, and just a tad over 2 came during the day. And the volatility of night was about 55 to 60% of the volatility of buy and hold. So in large cap space, you're getting something that was sort of 75% of return with 55, 60% of the volatility, and thus had a higher Sharpe ratio than the index itself. And night has a much higher Sharpe ratio than day does. So day, if you think about, the converse of night, right? You have a session that rewards you quite poorly, lots of volatility, 2% return historically. And by the way, in small caps, small caps was really the shocker. Also about a 9.5% annualized return, 12.5% at night, negative 275 or something like that during the day. So if every more, and this is just using opening and closing prices of ETFs. So the IWM, the big iShares. So if for 20 years in a row, you bought it at the open and sold it at the close, you'd be down 275 before T costs and anything else, fees or anything.
You mentioned some of the academic research that supports this. A lot of our listeners are factor investors, so they'll probably want to look at that. Could you just talk about maybe some of the papers that are out there that have supported the night effect?
Yeah, there's a number of different professors who've written on it, and we've talked to a few of them. They range from lots of universities. We talked to a guy in Cal Berkeley that said CAPM works at night, but it doesn't work during the day. We talked to some guys at the University of Chicago, Illinois, who found excess return at night. They were trading it themselves. One of the papers is written by the Federal Reserve Bank. They've updated it a couple times over the years. And they talk about an excess return that comes when Europe opens in the futures market. So yeah, there's a lot out there. And there's papers written by foreign professors looking at international markets, and they found the same effect in most developed markets around the world.
Did they find anything as to why it works? When we look at factors, we typically try to say they work for one or two reasons. Either they're taking more risk or there's some sort of behavioral anomaly going on that allows them to work. Were they able to look at that and figure out why this works?
Yeah, it's a great question. I'd say there's three main areas of discussion around why it works. One is related to information flow that comes when the markets are closed. So, earnings announcements and the M&A announcements. And so if you're not invested prior to the announcement, you may pay up to catch the exposure. So that's one. In terms of the investor behavior, I think that's probably, for me personally, more intuitive on a couple levels. One is that you have institutions that like to de-risk at the end of the day, and they de-risk for lots of different reasons. But I've talked to people that run trading desks, for example, and they're like, I screen up my traders every night to go home flat because their business is not taking overnight risk. It's just doing things during the day. That's one part of it. There's other things when you hold overnight that they want to avoid, like capital charges and interest charges and marks to market and things like that. The other investor behavior component that's really interesting now is just, who's trading during the day, who's trading at night. So during the day, or let's say during the night, not too many people, right? There's futures market, there's news coming out of Asia and Europe that institutional traders might trade on, but there's not that much going on. It's a pretty quiet session and there's no retail investors, on balance. But during the day, you have big retail, you have algorithmic trading going on, you have day trading community, you have all these things that are moving the markets around and seem to be detracting from performance. So, that from a behavioral standpoint, that feels right to me. Other behavioral things are, retail traders buying in the morning and institutions, being more disciplined about not buying into the open, things like that.
Yeah, that retail thing is interesting to me. When we had Jason Zhu on the podcast, we were talking about like factor investing in China. And, one of the reasons he said factor investing works a lot better in China is because there's way more retail traders. So I think it would make sense probably, that during the day, there's way more retail traders. There's probably more dumb stuff going on, than there is at night.
Yeah, very possible. Very possible.
I wanted to ask you, whenever we look at a factor, we always like to go back to the Complete Guide to Factor Investing by Andy Birkin and Larry Swedroe. And they have sort of a list of criteria that they use to evaluate any factor. So I wanted to work through each one of those individually with you and ask you about them. So the first one is persistence. Does the factor historically deliver reasonably reliable returns? So how would you look at this factor through that lens?
Yeah. So we saw the persistence, again, across many sub-asset classes in the equity world. We saw it on the local markets of every country, just about. Again, so this is, if you're a German investor and you buy the DAX close and sell the DAX open, we saw it. So it doesn't necessarily transcend countries, or that requires a little more research, but we see it locally. We saw it. It does not work all the time. So, persistence doesn't mean works all the time, but we looked at it over many, many years and found there was something there. It might work 53% of the time or something, but, if you're like the blackjack dealer, and you have 53% on it to make a lot of money. So it's kind of like that.
Yeah, well, that's common with all factors. Obviously those are the value investors learned that value doesn't work all the time. We learned a pretty harsh lesson in that over the past decade. And How about the idea of pervasiveness? Have you looked at it in other asset classes?
A little bit. So it's interesting. We've looked at it like at high yield bonds, and it seems like they have an equity like component, so it's kind of there. But as you know, high yield bonds, the pricing's a little trickier, the liquidity's a little trickier. So, we haven't done too much with that. With treasury bonds, they seem to have like almost the opposite of the night effect. They have a day effect, right? Because when you de-risk at night to go out of equities, you go into treasuries. So then anyway, so we've seen a little bit there. We've looked at it in commodities. We have seen some night effect in commodities as well.
The next one, robustness, I think may not apply here because it's can you define it in different ways, but the night, it's either the night or it's not the night. So I'm not sure really if you would want to define the night in different ways.
Yeah. I mean, if you look at some of the research, there are periods of the night that do better than other periods of the night. So there's things around the opening in Europe in the first few hours of Europe that are better than, the last few hours of Europe. So it's interesting.
That's interesting. So they've actually gone deeper, not to just say there's a night effect, but also to break it down. When is it stronger and when is it weaker?
Exactly.
Intuitiveness, does it make sense? Does it make sense that it would work?
It does to me once I've studied it. I think initially it's sort of counterintuitive in the sense that people fear the night. Some people think the night's really volatile, which is not true compared to today at all. So it's a little initially counterintuitive, but then when you think about who plays at the different times, then it gets a little more intuitive, I think.
And the last one's investability, which is I think is an interesting one here. Like, how easy is this to capture in the real world?
Well, this is a critical one, right? So all these papers identified there's a night effect, and the question is, can you capture it? And of course, many of them said you could, not fully, but partially. And when we looked at the night effect, for example, there are many other places we would have preferred to have a fund that had a much greater night effect than the S&P 500, let's say, but we couldn't necessarily see ourselves scaling it. So I'll give you an example. Cannabis stocks had a great night effect, but we didn't want just a cannabis stocks night fund. So we leaned into areas where you had large liquid futures contracts and the ability to transact very inexpensively. So that was really important to us in our ability to capture it. And we're finding, so far that that part's not been a big challenge. The big challenge has been, just the night itself has moved around a lot versus the day since we launched. But, that's how we got there. So investability was a really important criteria for us.
So is that the idea you want to try to buy the close as close as you possibly can with futures, and then you want to sell the open? I mean, is that the general idea you're trying to get at?
Yeah, absolutely. So that's what we're trying to do. We're trying to be very systematic, doing the same trade every day, in the eyes of the customer, so we're predictable. So we, use an algorithm to trade very, very close to 4:00, very, very close to 9:30 in the morning.
What is the impact of transaction costs here? I mean, are you able to capture it pretty well, or transaction costs a significant issue?
We don't think they're going to be real significant. We think, so there's two elements in that. One is the commissions we pay to trade futures, which are pretty small. And then of course there is bid-ask spread, and then we also get income on the cash that underlies it. So we're sitting in cash and treasuries in the fund and trading futures on top of them. So we're getting 3.5% to 4% yields. We think that in large cap space, the T cost annually might be 1 to 1.5%. And then it's a bit more than that in the Russell too. But that still leaves, some capture in the night effect.
You sort of highlighted small caps before in cannabis stocks. Are there other areas of the market or other sectors or something like that where this effect is stronger than in certain other areas?
I mean, absolutely. We've carved up the market, as many ways as you can, and it's fascinating to look what happens. And meme stocks was another area, at one point that had a huge night effect. And you could sort of argue with the retail flow and meme stocks that might have made some sense. So yeah, lots of areas to look at. It's under constant study. And, we may do some more active things over time that give you sort of baskets of different areas of the night effect.
Are there certain areas you think might be ones you'd want to expand into the future? I mean, some of these areas, like you said, with cannabis stocks, it's there, but it's hard to capture. Are there some other areas as you think about your plan in the future that you think might be like ripe, fertile ground for you to expand into?
Yeah. I mean, there are, I don't have them all the top of my head. But I think the idea of having a basket, maybe an ETF of ETFs that, looks at the night at a different level so that, instead of trying to execute 100% of the stock in a cannabis stock, 100% of the fund in a cannabis stocks, maybe it's 5% of the fund. And then we can get comfortable with the investability of it. So, that's something we're looking at.
One of the unique things you guys do, which in looking at your website, is you sort of have two different ways you approach this. You have the one way where you're just buying at night, and then you have the other way where you're owning all the time, but sort of leveraging night. And I'm wondering if you could just talk about the pros and cons of those two different approaches.
Yeah. So the NSPY is the one, that seeks to duplicate the 75% of the return with 60% of the volatility. So that's just invested overnight, not invested during the day. And that's kind of a risk-adjusted trade, right? You will earn less over time historically than holding the spider outright. You'll have less volatility, but it's a volatility-adjusted trade. So we wanted to introduce another one for investors that didn't want to give up on the return side. And so there we have NSPL as the ticker, and it's 100% invested during the day, but then it leverages up the night an extra 50% to give you the night tilt. And that one over time had about 325 basis points outperformance against the SPY before, T costs and fees. So that one was interesting. And I think investors find that to be just more of a straight equity substitute, and the volatility, it's a little bit higher than buy and hold. So buy and hold is about a 19 vol, and our fund has about a 23 vol. But because you are leveraging just this kind of quieter night period, the vol is not excessive. And just to give you a sense that the QQQ is about a 22 vol.
Yeah. So the idea is you're getting a significantly better risk-adjusted return doing it that way. You're getting more of the return at night, but less of the volatility. And you're leveraging that area of it.
Yeah. Very targeted use of leverage. So like when you look at Sharpe ratios, the index has like a 0.6 Sharpe and night's like a 0.68 or something, but day is a 0.2 or 0.21, something like that. So it's really that the night has a much higher Sharpe than the day. And so you're just leaning into that.
Are there certain market environments where this tends to be more or less present? I don't know. I don't know if volatility picks up or if maybe bear market environments where night tends to do better.
Yeah, that's a great question. So we've looked at this a lot of different ways, and it's hard, finding out exactly when this works will be really the holy grail for us and investors. And, but we have seen, some interesting data. So if the markets are really choppy or down, this is typically going to do pretty well, because the day session is going to struggle. In times when the day session is running hot, this can lag. And we saw that right after we launched. We launched June 28th. The S&P was at 3,600. By August 15th, it was at 4,300. And we lagged. And most of that bounce came during the day. So we've done a little bit of analysis on kind of the two funds. When would you hold the risk-adjusted NSPY and when would you hold the equity substitute NSPL? We found this cutoff point based on a regression line through the past history that said, if you thought the market was going to be 5.9% up or less, you'd want the risk adjusted. And if you thought it was going to be higher than that, you'd want to lean into the full equity trade. So that was just to put a historical context around it.
It seems like there could be like an interesting rotational strategy there where you could maybe have like a fund above them that might decide which one to be in and maybe rotate among them over time or something like that.
Yeah. I think, rotating in and out of the night effect is something that can be interesting. I think when we talk to some of the professors, they would say there are certain times when it's more pervasive than others. For example, after a very large drop in the market, the next day is likely to have a stronger night effect. So as an ETF provider, we want to be systematic, transparent, and predictable, right? So it's a little hard for us to bake some of this into the product. But investors can use it, however they want.
And you had mentioned this earlier that, obviously this anomaly exists, but it doesn't always exist. So if we were to take the last 20 years, I don't know if you have like this type of data, but I'm just curious in general, like, what percentage of time would the night effect, based on your testing, do better than the day effect?
I would be guessing the exact numbers because we've seen so many numbers, but it is something slight, like in the 53% range. It depends if you ask that question daily, monthly, quarterly, annually, right? As well. I don't exactly have the numbers, but it's something, it's not that dramatic. And I think people have always asked me like, well, if it looks too good to be true, why doesn't it get arbitraged away? And I think that's the answer, right? Which is, it's not like it's happening 65% of the time or anything. You got to be in it for a long period of time to capture it.
One of the potential, benefits, I'm interested in what you think about this is, during the day, investors that are invested in vehicles see the price changes and are more likely maybe to make changes and bad decisions. I'm thinking like retail investors, or it happens to professionals too. It seems to me like because your movements are at night, you might actually help investors. They're going to see the change of performance over time. So if it doesn't perform, then they're probably not going to, many investors or some investors won't stick with the strategy or the ETFs, but they're not seeing this. If the market's down 3%, they're not seeing it like in real time. So it could actually help with investor retention and, sticking with the ETF potentially.
Yeah. From a behavioral standpoint, it's a good discipline, right? But I don't think anyone should view NightShares as 100-0 for your portfolio, right? This is something that you blend in to add a tilt towards this factor, this night effect. And on days when the market crashes intraday, you're pretty happy that you have a piece of it that's not crashing because we're out. And that's what we found. So I think the best way to think about this is it's got some properties of an alt in the sense of less correlated. I think the night is like a 0.63 correlated with buy and hold. It's not particularly correlated with other parts of your portfolio, your commodities, your bonds, et cetera, either. So it's not like overlapping correlations with anything else. So it provides diversification benefits, a different risk premia, some non-correlation, those things that you sort of associate with other factors and other alts.
On that behavioral thing, so people who are invested in the fund probably are not, during the day, are you owning like short-term bonds or something? They're not seeing any volatility, right? They're just, once it opens, they're not seeing any volatility to close, right?
Yeah, it's got a strange construct that way, that during the day, it's kind of stagnant in terms of the bid-ask spread. And then all the activities overnight. Yeah. It's kind of it gaps up or down.
Yeah. To Justin's point, I think that would be a really big benefit. Like I'm looking at my portfolio today, like when we're talking, the market's tanking, like, a lot of people are very, they have this tendency to want to go pull the trigger and be like, I can't take this anymore. Let's sell. This is good from that perspective. You're at least during the day when you're awake, when you have the ability to take action, you're not seeing that volatility.
Yeah. Again, right. Blend it into the portfolio. I think that makes perfect sense, right? It does. It's a level of protection. And, again, there are days when the market sells off in the morning and rebounds during the day and we miss it. Right? And there's days where the market opens up and reverses and goes lower and you're happy you're out. So, there's all kinds of things. And I think you just, again, just have to blend it in.
Just thinking back to when we had our ETFs, we had a lot of small and mid cap stocks. So when money was coming in and being put to work, the market makers would have to go in and buy those. And sometimes we might see movement, but we were trying to buy as liquid stuff as possible. But, we knew that there was sort of like a scalability issue. If our ETFs ever got to become really successful, we would have had to scale in to these positions over time, but you don't really have that problem, right? Because you're buying.
I think at some point, if we were a $10 billion small cap fund trying to, trade the way we trade today, we'd have a problem, right? So I do think, as we scale, we'll have to look at it. But in large cap space, we're a pretty long way off from having problems. The S&P futures market's pretty darn liquid. But we can always just change the way we try to capture the night effect, right? We can, right now we're very close to 9:30 and 4 o'clock because we can be, and we're not moving the market around. But we could just change our trading strategy over time as needed to keep T-cost bearable.
Well, this is, it's going to be very interesting to see sort of how this strategy does, how your firm develops. And we certainly wish you the best of luck. I mean, we know, small ETF issuers, it can be a grind, but like you said, it's about, I guess, the strength of the idea. And this is one that, no one else is doing. So it certainly gives you a head start and, an edge. We like to ask all of our guests sort of a standard closing question. And that is based on, you can go anywhere with this, based on your research and experience in the markets. If you could teach the average investor what lesson, what would that be?
I think it's just, keep your mind open to new things. There are constantly things being learned and previous relationships that no longer hold up as well. A good example would be just, now that bonds are in an uptrend after 30 years of a downtrend, like the world looks completely different and you have to just really reassess prior relationships. So, I've looked at market structure over time, the way that's changed, the way things trade. So, the one thing about this world, it is not stagnant. And so, learn a lot, but then keep updating your knowledge.
Great. Where can people go to learn more about your firm, Bruce, and the ETFs?
Yeah. NightShares.com is the website. They can follow us on LinkedIn and Twitter. We have some cool tools on our website. One's called the Night Watch that allows you to sort of disaggregate the 24 hours into the day and night. One's called the Night Vision that allows you to customize a time frame and see how the night effect did. So there's lots of tools. And of course, if you reach out, there's a way to contact us on the website. We'd love to have a chat.
Great. Thanks. We'll put links to all that stuff in there. We appreciate your time and good luck with the ETFs.
Thanks so much, guys. Appreciate it.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.